Good evening, everybody, and welcome you all to Carnelian's quarterly catch up. Like most of you are aware, through these interactive sessions, we connect with all our investors and partners to appraise them on our view of the markets, new product launches, etc. This quarter's session, we will focus on the most burning question which all of us have markets from here on to where, along with the launch of our new AIF, the Carnelian Structural Shift Fund, which will be detailed upon later in the session. I'm also happy to share that our shift strategy has been ranked number 2 amongst the top 30 PMSs based on quality, risk, and consistency parameters by the PMS AIF world. Without taking up much time, I'll hand it over to Vikas, who will run us through today's session. Thank you.
Thank you, Swati, and good afternoon to all of you. Thank you very much for joining us. So before we get into the session, let's have some action. So we'll do a small poll. So I would request Tanay to just, it's a very quick poll. Don't stress about it. Whatever you feel, when you read the question, just answer whatever comes to your mind. There's no right or wrong. We're just trying to do a mood check. So Tanay, can you go ahead? So please sort of give your, we will take about a minute or so. There are only 5 questions, so please participate. Let it keep coming in. I think we're there. There's a question, next 12 months, yeah. Request part. I think almost 2/3 participants have sort of participated. Still waiting for a few more to do. So I think most of you, at least about 60% of you have answered. And let me share what we've got. So do you track US markets daily? Almost about 50% of the participants are saying yes, and half are saying no. And this number probably, if we, I think I did a similar survey, about 5-6 months ago, and I think this number was about 1/4 of the participants were tracking. Most of the people were not tracking. So I think obviously clearly it shows that what's happening at the top of the mind, what's happening in the investor's mind at this point in time. It's just the indication. Currently, do you see more risk in the market or opportunities? 40% participants are seeing more risk, 60% are seeing more opportunistic, so which is, I think, good. At least we have more optimist lot here. How do you think markets are likely to perform? So we have roughly, this is where I think roughly 40% participants are seeing market to be negative in the course of this year, and about 30% are seeing up to 10% return, and up to more than about 30% are seeing more than 10% positive return. But here also I am seeing a little bit of positivity. What are the major risks which are worrying? Of course, inflation is the number one worry, and Russia and Ukraine war has gone down, which was again a very big worry a few months ago. And how invested you are, I think only, despite the optimism, only 20% of the participants are invested 100%, and about 60% participants are sitting between 10 to 20% or more cash. So of course, the bit of a worry and caution is reflected into the cash levels or invested levels of the participants. So this is just a sort of snapshot of what everybody is mood out here. So I think if I were to summarize, probably the mood out here is cautiously optimism. I think I see 60% people see markets to be more than positive, and 0 to sort of 10% or 40% of the participants see markets delivering at least 10% return, and about 20% see more than 10% return. So yeah, so friends, thanks for your enthusiastic participation. This was just to do the mood check of how participants are thinking and feeling right now. Of course, I'm sure all of you are very, very worried right now, or seeing the risk on the horizon, and thanks to the kind of volatility which we are seeing on a day-to-day basis. We interact with many of you individually, and many of our other clients who are not there on the calls. Generally, the mood summarizes today a lot of optimism, a lot of caution, a lot of worry points at this point in time, and rightfully, because we are seeing a lot of caution getting built, especially the number one worry across the board, especially in US is about inflation, and what could be the implication of that at the global world. That is the critical, the most important question is happening. So we'll deal with that in the conversation today we have. But feel free to keep posting of your question. If we will have definitely Q&A session post the session. But in between, if you have, please feel free to post your questions. So friends, beginning of the year we had when in our newsletter and in our last call we said that this year is going to be a bit the year of the caution, and our letter also talked about that. We will see probably a bit of a de-rating in the course of this year, primarily led by the interest rates going up and the liquidity withdrawal. And partly some of them are playing out, and partly probably would play out through the course of this year. Of course, when we wrote that letter, Ukraine war was not on the horizon. That had added to the sort of woes. But the silver lining or the positive side is, who would have thought that despite Ukraine war, which was not there on the horizon, inflationary pressure, Shanghai lockdown adding to the supply chain pressures, and FPIs, withdrawing almost close to 140,000 crores in the course of last 6-8 months. Markets are holding on pretty well. If this was any other kind of situation, probably markets would not be holding on that well. I remember when FPI, there was a time when FPIs were, even if they sold $2-3-4 billion, market would be down 15-20%. And this time around, despite such a large selling pressure, our domestic capital has absorbed entire selling pressure, and markets are only down 4-5% from its previous peak, which speaks volume about the optimism inherently built into our Indian economy, and secondly, of course, liquidity which is there in the hands of domestic investors, which is looking to find its home from a point of generating long-term returns. So this is clearly the case. So the way we are seeing at this point in time, the environment is that global situation, of course, is quite worrisome. There's no doubt on that. We don't see global supply chain issues sort settling down anytime in a hurry. We don't see, I mean, Ukraine war is obviously nobody knows when it's going to come to an end. And I think we all believe or thought that probably it will be a few weeks' time, and it's beyond 60 days now, and I think it continues. So probably even media has stopped covering now on that front. So that worry has decided. But I think inflation is going to be sticky. We have all heard and read stories how in US there are lots of sticky inflation points are there. And one of the example which sort of hits me the most recently when I read a news item that Walmart hired a fresh truck driver at the salary of $100,000, which is unheard of, right? In US, graduates get salary of $50,000, $60,000, and a trucker getting salary, and that clearly shows the shortage of labor which is happening in the US markets. Apart from, of course, the commodity prices, oil prices, and all those led inflation, food inflation is one part. The wage inflation is also, I think, fairly large. So I think that situation is definitely sort of worrisome, and we'll have to wait and watch that how that pans out. Of course, Fed has sort of clearly articulated that they would want to tackle inflation. They have articulated the interest rate policy and liquidity withdrawal policy, and we think that probably there could be more to that. And Fed, some point in time, if inflation continues to remain out of hand, might there is a small probability, or I would say 20-30% probability that might act little bit out of the shock, or might have a knee-jerk reaction, or maybe interest rates can be slightly much beyond what they already guided, and that could probably create some amount of nervousness in the market across the globe. So we have to be prepared for that kind of environment, because that risk is real, and that risk is not going any time. Other than that, I think, as far as the Indian economy is concerned, of course, in India also, we are seeing inflationary pressure across the board. And whenever this kind of sudden and sharp inflation comes about, albeit with a lag, but it also has an impact on the demand. So, we cannot wish away inflation from India also, though it is not at all in the right now at this point in time at alarming rate. But if it continues to sort of stay and be sticky, then we might also see some sort of impact on the demand. To give an example, many companies, we were very, very bullish on the capex cycle, and we still are. But just to give an idea, many companies who were planning aggressive capex are now beginning to postpone for a couple of quarters and see how things are going to pan out. The reason being, the capex costs have gone up by 40 to 50%, primarily led by the steel cycle, primarily led by the a lot of other cost of materials which have gone up, including cement, including wages and everything else, right? So that part is definitely, if the capex companies are postponing their capexes, of course it will have an impact on demand of the capex companies, and at the same time also future growth in the volumes which was supposed to contribute. So this is how inflation starts impacting the growth at the margin. And so I see situation, if this continues same way, it will happen in US. In US, we are already beginning to see home sales coming down, and probably same thing can happen in India over next 3 to 6 months. So what we are seeing is a bit of a postponement of a slowdown of structural thinking in the demand. So the numbers still have not slowed down. The actual numbers currently are still reasonably robust, but we all have to kind of anticipate what can happen possible with the current facts. So we think that potential of somewhat tapering of the growth can be sort of there with us, and one has to keep in mind. Other than that, frankly speaking, I don't see, it is very cliched to say that India story remains intact. We are very, very positive on India. But today, while we have to navigate the short-term volatility which is ahead of us, frankly speaking, I don't know whether markets will be 10% plus or 10% minus through the course of this year, because there are lots of variables which are kind of data dependent. We'll have to keep watching and evolving. But I frankly don't understand why one day international markets are down 1% and the other day, very next day, they are up another 1%, and this is happening for last many weeks. And this is clearly showing the clear state of confusion within the markets participants, that how the world is headed. right? So we'll have to keep watching. But this year, I don't see markets, to be very frank, in a big way, runaway sort of rally, and nowhere close to what we saw obviously last year. But even this year, if we are positively, and this we said in the beginning of the year, that if we do early teens kind of return this year, we will be very happy and lucky, because the risk and volatility which we see are fairly high. But very important point to note is that this is the period, or this is the year, which will also form the base for one of the best returns ahead of us. And I would like to share some of the thought processes with you today, that how should you look at India, from a next 3 to 5 years perspective. What are the various drivers of Indian growth, and what are the various sort of pillars of Indian growth which are there, and which all of us must keep in mind as we are investing our wealth, as we are building our portfolio. And I see, from that prism, and when I see from that prism, frankly speaking, it allows me to withstand this volatility without much of headache, and without much of worry. Of course, one can never say, one can never sort of overlook risk. I will never say that don't look at risk, but if I have a larger perspective and understanding of those larger drivers of the growth, it allows me to stay put in the investment story for a long term, and that is what we are also going to deal with. So, friends, if you look at a little bit of background, and then fast forward, if you say 2014 to 19 period, post the NDA government came, a lot of structural reforms were carried out. And started with Jan Dhan, then demonetization, GST, IBC, RERA, and many more. When they were carried out, they were, of course, in some sense painful to all of us. They created some pain to all of us in one or other form. But they were also towards the building the foundational sort of platform for India's growth, on which India's sort of growth building can be growth can be built upon. So all of them created pain, and I think Indian economy took knocks in that period. Also, around the same time, unfortunately, we got hit by ILFS crisis, which was our India's Lehman moment, right? So during the Lehman moment, when US markets got hit by the global financial crisis, their Fed pushed liquidity in the system. Our RBI, that point in time when the ILFS crisis happened, we pulled liquidity out, which compounded the problem, and again, created a very big dent in the economy. But fast forward, when the in 2019 we had a change of the government, we had a change of the leadership at the RBI, and both started working, in terms of driving the growth and pushing liquidity in the system. And the economy was nicely, if you all remember, December 2019 quarterly earnings were very robust, and economy was nicely coming back. And unfortunately, we hit pandemic. Now, pandemic, of course, was a very big once in a 100-year kind of event. It, humanity-wise, it has been a very sort of disastrous situation for all of us. We have had losses in one or other way, but economically speaking, it has been a very big boon for India. And it has put India in a very different trajectory. And if we understand this particular aspect, that along with what was the foundational work done in last 5-6 years pre-pandemic, combine that with the accelerated drivers post-pandemic, you will understand that what can happen to India over the next 5 to 7 years. So pandemic brought two very big structural shifts in India. Those two structural shifts, in an accelerated growth form, has a transformative impact on India in terms of putting the growth of Indian economy in a very high trajectory. And we'll talk about that. What are these two structural drivers? Number one structural shift or structural driver which changed post-pandemic is our IT sector. We all know that our IT sector has been a very big sort of industry for us. India controls services almost 90% plus market share, and this sector pre-pandemic was growing at a low single-digit kind of growth, and pandemic changed the game. Every company globally was forced to spend money on digitization and cloud migration. The sector which was growing single-digit growth started growing at 15-16%. When a sector of that size and scale grows at a high teen it creates a massive amount of impact on the industry. So India's IT exports pre-pandemic was about $165 billion. There are different studies. NASSCOM recently came out and said that Indian IT industry will grow to a $350 billion. Now, even if we take this $165 billion of exports going to $300 billion over the course of next 5 years, it's a very big game-changing event. Of course, one is as an investor to make money from the IT sector. I am not referring to that alone. I am referring to this $165 billion of exports of IT going to $300 billion. Its transformative impact on the Indian economy. When an IT sector grows from 165 billion, we adds about another $150 billion of revenue. It's an export revenue. In IT sector, 50 to 60% of the revenue goes into salaries. So if we take another $150 billion of revenue, 50% of that becomes $75 billion. So we will add $70 to $75 billion of salaries into the Indian economy. You can discount that and you can take 5 to 6 times. You will take $50 billion, $60 billion. We will add that much kind of additional incremental salary to the economy. This kind of income creation in the economy will have a huge impact in terms of multiplier impact. To give you context that how large this number could be, all of us have one data point from the past experience. And if you relate to that data point, you will realize that what this change means. Manrega, when it was introduced in 2009, we all know that it was meant to spend money toward the rural India. And in that period, rural demand just grew disproportionately. All the consumer companies, FMCG companies who had presence in rural India massively grew. And there's the market caps became 3x, 4x, 5x in a 5-year period. Right? So the growth sort of came big time on the consumption side in the rural India in 2009 post Manrega introduction. The annual allocation of Manrega has been only $10 billion. So you can understand if a $10 billion spent into the economy can create or unleash rural demand in that period. IT sector, which is going to spend 50 to 60, 70, whatever the number is, we will know in the fullness of time, but 5 to 6 times of Manrega coming only from alone IT sector. This is a very big change. And today, IT sector is not restricted to only urban. Now, IT companies are hiring even employees in semi-urban. So, work from home has been the norm now. So this is going to be having a huge impact on the Indian job market as well as the demand cycle. Over and above, we will earn about $150 to $160 billion of forex. And on this part, we will come to in a minute after some time that what is the implication of this. Second big shift is on the manufacturing side. We all know that our manufacturing sector, while there was a program called Make in India, but it was despite all of those efforts, it was not growing at a very, very rapid pace. India's manufacturing GDP remains woefully low at 16%, around $450 billion. Post-pandemic, post-Doklam crisis, many things changed, which has given a significant impetus to this particular segment, the manufacturing GDP, right? What are these changes? One, I think government realized post-Doklam that China does not need to fight war with you on the border. They can just stop supplying of APIs, your entire healthcare system is down. And many more vulnerabilities. So government of India decided to reduce our vulnerabilities on China, and they came out with a very, very aggressive sort of plans and Atmanirbhar Bharat, under which they have PLI, which is boosting, and they've identified about 12 industries under PMP, phased manufacturing plan, where they want to see imports to be zero in 5 years' time. And a lot of programs have been rolled out to move towards self-reliance. And this is we all read every single day that how it has kind of started moving the needle. Apart from that, government is also working, which is very, very unnoticed and cannot be talked much about, is government's focus on non-tariff barriers to protect domestic industry. Historically, India never used non-tariff barriers. Now, India started using non-tariff barriers in terms of giving protection to the local industry. Like example is that earlier anybody could sell power equipment in India. Most of our power industry is built using Chinese equipment. Now, anybody who wants to sell Chinese equipments in India for power sector needs registration with Power Ministry. And like this, no tender more than 200 crore, less than 200 crore needs to be going for international bidding. This is opening up huge demand for India. The competitive intensity in that business goes down. So a lot of such non-tariff barriers have been kind of done, which is giving a lot of impetus to the domestic manufacturing. Secondly, we all know that China plus one, every global company who's been outsourcing from China, whose global manufacturing market share has been about 28% away from China. And this is, we every single day read, feel, and in our interaction in our news flow, right? I mean, in our interaction with the companies. So every company wants to diversify away from China to elsewhere. India is going to be a very big beneficiary of that. Even if a small proportion, few percentage of shift can be a multiplier factor for India. When you are 28% share in the global manufacturing, then I think even 2% shift is a big opportunity for India. And India is definitely beginning to see that benefit of that. And also combined with the fact with this has created the demand environment has changed. Apart from the fact that India's cost competitiveness towards China, vis-a-vis China, has gone down significantly, improved significantly. I'm sorry. India's labor cost is $250. China's labor cost is $800. Our power cost and China's power cost is more or less same, 8 cents per unit. Right. Our logistics costs are slightly inefficient, but that is getting better with DFC and a lot of focus of the government. The point is that I think in many sectors today, India is better. Indian currency vis-a-vis Chinese currency has depreciated by 15% in the last 18 months. That also gives advantage to India from a cost competitiveness perspective. So combination of many of these factors, I think our manufacturing sector is going to see a very, very big demand, very big growth over the next 5 years. So of course, again, one is the opportunity in the manufacturing sector, but I am trying to explain you from a transformative impact on India's perspective. So our manufacturing GDP, which was 16% of total GDP at $450 billion, government is targeting at 25% of the GDP. Let us, for understanding sake, only take 20%. So 20% of the GDP, which is of $5 trillion, at $1 trillion. So in 5 years' time, we will double our manufacturing GDP from $450 billion to $1 trillion. Now, what does this mean? Unlike IT, in manufacturing, 10% of the salaries spent on 10% of the revenue spent on salaries. So 10% of $500 billion is $50 billion. So another 5 times of Manrega coming from manufacturing sector. In manufacturing, for every formal job, there are 3 informal jobs. In manufacturing, you have both blue collar and white collar jobs. Right? In manufacturing, you need to do capex. So if you have to add $500 billion of revenues, you will add anywhere between $200 to $250 billion of capex. So your capex cycle kicks in. And once the capex cycle kicks in, that also has a multiplier impact. So if you look at the combination of these two, IT and manufacturing as a growth vector, these two did not exist in this size and proportion in this accelerated growth form. And which has changed the sort of complete growth driver for the country. And this is why I say that it has been an economic boon for India. These two factors put together has another very big impact on the Indian economy. We all know that India's vulnerability historically has come from only one factor, which is our current account deficit or our external account imbalance. When in India 2013 became part of Fragile 5, our current account deficit went on to become 4% of GDP, almost roughly about $80-90 billion. And we were forced to devalue our currency and forced to do those bond issuance, and our interest rates went up by almost close to 2.5-3%. So our vulnerability always lies in our external account. Now, these two drivers have a very big impact on our external account or current account. Currently, our deficit is around $40-50 billion, roughly about 1.5% of GDP. But think about it, if these two factors play out the way we envisage, which is adding $150 billion of IT revenue and another impact of $100 billion because of less import and more export on the IT manufacturing side, you will have anywhere between $200 to $250 billion of delta on our current account deficit, which means we will migrate from current account deficit to current account surplus. When you move this, your dependability on the external money just goes down. You don't need external money. Only 4 countries in last 40 years have gone through this journey: Japan, China, Korea, Taiwan. Once countries cross from deficit to surplus, they have a golden period of 5-7 years, and this is a structural. So I see that India, over next 3-4 years will migrate this journey. It will not happen in next 1 or 2 years because we are right now importing a lot of capital goods, which is a good import because we are building capacities. So it might not happen, and today oil prices are also elevated, so it might not happen in next 1.5 years. But if you look down 2 years, 3 years, 4 years down the line, I don't know which year it will happen, but I know directionally we are moving in that direction, where India will run current account surplus, and our reliability on the or dependability on the future external money will go down, and we will remain very sort of self-sufficient in that. This has a huge transformative impact even on how the country is looked at, because we will then be will not be vulnerable like how every emerging market is vulnerable, and that kind of allows us to manage our own fiscal deficit, manage our own interest rates, and we are not to that extent linked to any other external rates. That's how China has been able to manage low interest rates for long period of time because of their current account surplus. So this is a very big transformative impact. Now combine these two factors along with our banking sector, which was in doldrums, now fully capitalized, ready for growth, well provided for, and we are seeing a lot of changes in the banking sector. Unlike past, our banking sector is one of best solid place. If you see 2005 to 7 or 8 cycle, post that cycle, we saw a lot of retail NPAs. That time we did not have civil infrastructure. In 2009 to 14 cycle gave us a lot of corporate NPAs. That cycle we did not have IBC. Now we have both. That gives me confidence that because of the enabling infrastructure, also enabling data infrastructure, where you don't need to depend on only on the client to provide you data, your credit assessment, risk assessment has undergone a paradigm shift that will reduce the cost of credit cost in the system. So I feel banking sector has never been so solid and well placed in the economy. Our real estate sector, which was in again doldrums for last 10 years, is back post RERA implementation, post all the cleansing, and with the demand and job creation, we are seeing ready inventory pretty much all-time low in most of the cities, so looking up. And whenever demand picks up in the real estate, we all know that it has a multiplier impact. Every house bought, you have people buy. You need paint, you need fan, you need air conditioner, you need furniture, you need everything. This kind of multiply, right? And with the job creation, which I just talked about, because of two accelerated drivers, you will see more and more demand getting created on that. Our infrastructure sector, which again government, we all know that government is spending money left, right, and center on ports, roads, airports, railways, urban infrastructure, sewage, everything. I think there's a massive amount of upgrade which is happening across the board, and I think that is also having a multiplier impact. So if you look at combination of all these factors put together, it all, when all these things come together, the amplifying effect is not going to be only 1 + 1 = 2. It is going to be much more than the sum total. And that is what I am seeing as the new India opportunity. And whatever all I told you, this is very commonsensical, very logical. It is not some big complex jargon. So the reason why I wanted to share this with you is so that one can understand what is unfolding for us over next 3, 4, 5 years. And when we have that picture, then it becomes a lot more clear, a lot more sort of convincing for us to stay put. Of course, when we say this, the journey will not be smooth. No journey is ever smooth. There will be volatility. There will be issues, local as well as international, which will be creating short-term and hindrances, short-term problems. Markets will be correcting. We have seen in many cycles, up cycles of the market still correct 10, 15, 20%. So those all are going to be there. Like we are seeing current volatility this year, volatility will remain high. That will continue to be there. But if one has this kind of perspective, then one can sort of put up with type B risk, as we call it, that is volatility risk, and focus only on type A and type C risk, which is risk of total loss of capital and opportunity loss of opportunity cost. So if you focus on type A and type C risk, you can sort of continue to do well. So this is the sort of broader perspective I wanted to sort of share with you all. And I would be very happy to sort of take questions with all of you on this. But before I get there, let me sort of also take about 10 minutes to talk about our new fund, new AIF, which we have just launched. And this AIF is again pretty much on the lines of the shift strategy which we've been doing, which Swati talked about, that it has been performing well. It has been performing well over the last 15 months, but this we are doing in an AI format because we felt that this is a very big opportunity, and we have to invest with a 5-year perspective in many mid and small cap companies, which is going to become 5x, 10x in the fullness of time. That's the reason we launched this strategy. So this fund is going to be basically investing into two broader themes, as we call it, structural shift fund. So these two structural shift I talked about, in these two structural opportunities, it will invest 2/3 into manufacturing and 1/3 into technology. This is the broader thought process about this fund. And manufacturing, many of these things I've already spoken. It broadly, and there are many people will think that what are the sectors in manufacturing which will play out. Generally speaking, and they're changing, more and more getting added. But right now, as we speak, it is in chemical, specialty chemical, APIs, capital goods, engineering services, consumer electronics, auto ancillaries, defense, industrial capex ancillaries, building materials, toy manufacturing, footwear manufacturing. So it's been kind of there across many of these sectors, right? So this 2/3 of this opportunity fund will be invested into this. Technology, again, primarily when we mean by technology, we don't refer to the new tech as being talked about, likes of the IPOs which we saw last year. Here predominantly IT services or SaaS kind of player, which are basically cash flow positive. We don't understand still how to sort of invest into companies which are losing millions of dollars and still valued at crazy valuation. So here idea is to invest into companies which generate free cash flow, which are positively growing and can again multiply in next 4-5 years. And opportunity size I have spoken multiple times. Again, here the kind of companies we will invest into, with companies which have some core, especially in the manufacturing space, where they have some core competency, they have some niche capability, which is where they can compete with the best in the world. They have some advantage. It could be on the cost side, it could be on IP based. So where they don't need to prove themselves, they've already proven. It's just that when the growth is coming, they can just encash on it or capture it. So they have some proven track record, some platform, strong balance sheet. It is wrong to believe that in a mid and small cap, companies don't have strong balance sheet and strong governance. There are many exceptionally good companies in India which are following the highest standard of governance despite being small and managing their capital allocation very, very strong. So these are the kind of nature of the companies we will look for. And our standard investment process will apply to this also, as many of you have sort of heard us in the past that we have a very detailed, thorough sort of investment process where we look at business management and valuation in a very, very detailed manner. And this is a framework we have talked about many times in the past, that how we evaluate business, how we evaluate management teams. For us, more than anything, a management team of course takes the highest amount of the weight and priority, because we think that given in the same industry, management can play a very, very, very big role in terms of delivering or differentiating the return. So that's number one. And then of course we understand the business model, its moat, its opportunity size, its ability to kind of sustain the growth, sustain the sort of margins, and of course valuations these days become very difficult. So you have to constantly try to find what's the right price to pay, and you work at that. And again, there's a detailed process where we do channel check, we do sort of forensic analysis, and as many of you know that we have a very deep capability on the forensic analysis side, where we go into what is beyond obvious. And Manoj, you heard many times again, expertise is in that particular field. So we will not invest in any company unless it goes through the forensic check or forensic research, which we do. So this fund is again, category 3 AIF, where and the fund's life is about 5 years. And we basically, looking to do about 600 crores, 300 plus 300. And here we are going to call the investment over next 12 months in 4 tranches. And another unique part about this fund is that we are keeping, while the enabling clause is up to 49%, but roughly about 30% of the company, investment we will do into the pre-IPO or unlisted company, primarily in the manufacturing space, as we are seeing many companies which are, we're already seeing many companies which are sort of, ready to go public in next 1 or 2 years, but they are, very, very exceptionally good companies. Today, they are not available in the market. In the space of toy manufacturing, in the space of defense, which are today not there. There's no way you can get access to that. And we intend to get access to some of those interesting opportunities through this fund. But, I only want to caveat that if we don't find interesting companies, we will stick to listed market. But currently, we are seeing some interesting, once we started, we launched this fund, started engaging with the ecosystem, and we have, evaluated many companies, and probably will announce our closure of one transaction in next, 1 to 2 months. Minimum, like that is about 1 crore in an EIF to be drawn over a period of. So initially, we are calling only 25 lakhs. So these are some of our partners, which we work with. So yeah, and this strategy which we are running in PMS, like Swati was saying, that has been awarded on multiple platforms as best theme identification. Plus, I think how it has delivered the return. So we remain quite confident that this strategy should, or broadly, let me say that this strategy we are aiming to deliver anywhere between 22 to 25% kind of return over the course of next 5 years. So we think that companies which we are investing, unless they become 2.5 to 3x of their current size in next 5 years, it's not worth chasing this thing, because if there's a big tailwind, if there's a big growth, you've got to become that size, unless otherwise there's no. So you should have upside beyond that, but minimum you should deliver is this kind of. So that's the kind of filter we applied apart from other standard filters. That's the kind of growth filter we applied for the purpose of this fund. So this is what I had to share on the fund side. But I will pause here and look forward to address any of your questions, either on the markets or on the themes we spoke or on the fund. So please, and you can ask directly, you can put on the chat. So we have some questions, and some comments. So, thanks for your comments and compliments. I think, and please feel free to ask directly also, but I will read out some of the questions which are there in the chat window. Some are directly to us and some are in the comments. So, how long this ongoing market consolidation will last? Pawan, frankly speaking, the honest answer is nobody knows. But my sense is that, at least for a quarter or two, till the time we get some sense on the two factors. One is on the China lockdown, second on the Ukraine war, and thirdly, how sort of Fed is going to liquidity withdrawal, how it's going to pan out, the real impact of that. It's really a combination of that, and I think at least I see 2-3 months period or 1 or 2 quarter period, rather I would say, in terms of any meaningful direction to come out. And it could very well last through the course of this year also. Very hard to say that, but one should remain agile in terms of risk developing. But I think next 2 quarters looks like that's going to be a bit of range bound and shaky kind of market. And the good news is that despite all those worries, markets are cracking. So that also shows the kind of underlying strength and belief in India's sort of story, and even frankly, even global markets so far also holding. So that's a good news, but you never know. So one has to sort of worry. I right now remain cautious, and whatever capital also we are deploying. The reason why even in the fund we decided to call it over 4 quarters is because we thought that it's better to deploy in a staggered manner, because this year will be the year of investments. But at the same time, also uncertain sort of period around us. There's a question from Srinivasan. Do you think we seize the China plus one opportunity fully? It's a very sort of contentious question. I know many people and we have argued this since we've been talking about for last almost 18 months, and we've talked about this, many forums. It's never about, fully. What is fully? I don't know. Whether you should get 2% share from China or 8% share from China, nobody knows, right? Is the thing what we have to see is that there are certain sectors where India is capable of doing that. In all those sectors which we spoke about, India is, gaining disproportionately large market share. Some sectors where something like garmenting export, where countries like Vietnam, Bangladesh has taken lead, India is catching up now. Okay, and India is building on that. So it's a very big shift. It's a very long-term trend. So I don't think, and good fortunately, I think government of India is also very, very proactive now in terms of providing enabling regulatory framework, enabling support, whatever they could do. But in all these things, one thing I believe the key factor or key change is the demand, and that is to be seen. Many companies historically in India, and some of the companies were like, I remember one company was telling me that earlier I used to go to European buyer, and it took us 4 or 5 years, and despite we being at par on quality, cost, everything, we would sort of not get entered into, because here inertia. Because if you are continuing with somebody, why you need to change, right? Today, the China plus one momentum, has changed that inertia. And same guy was telling me that now their buyers are coming and giving them order in 3 months' time, and with online inspection, right? So this change is very important. And from all investors, we should never worry about, see, world is never going to be either utopia or dystopia. It is somewhere always in between. And from investors' perspective, we must notice is the rate of change. Is the rate of change positive? I think that's good enough. Now, whether it should be 5% or 2%, nobody knows. But even 2% at this point in time is good enough for us to give the momentum which India needs in terms of job creation. Now, will India be, ever provide full guarantee to the employment? Maybe not, but at least it is pushing large part of the population back to work if these kind of things play out. Today, we are seeing in IT sector, there's a shortage of talent, and even if people who passed out from second and third rank colleges are also getting jobs. Now that is employment, but we don't see that. We don't notice that. But the fact is that the same graduate who was not getting job today is fully employed and earning 3, 4, 5 lakhs rupees, which is a very big change, and that will have impact on the economy. So I always believe in seeing the rate of change rather than only saying that whether we have taken fully or not. That's how my perspective. But please feel free to disagree if you have another point of view. Another I think question from Nikhil is, please expand on why banking is still very volatile segment and not seeing the upside even after good results by HDFC, ICICI Bank Finance. Is the market seeing something else? Well, I think, of course, banking, if you ask me, is a large sector. It's been doing well. It's, of course, not performed as market sort of compared to other sectors. But I think this year we are beginning to see all companies sort of beginning to. ICICI Bank, which is our largest holding, has done very well in last 3 years. Last year also it did well. This year it has been stagnant. So banking, I guess there are 2 or 3 things which are as a worry which we hear, but which we also think that are kind of not so. That many fintechs will disrupt their business model. We don't believe that, to be very frank. That in banking, according to us, most important thing other than the technology is also liability side. It's a regulated sector. Money and technology, there are 2 important parts. But between money and technology, I think money is more important. If I don't have liability side, how will I lend to anybody? Technology alone can't lend. So I think there is a narrative which is there in the market that banking sector will get disrupted by the fintechs, which I don't believe. So we think that's one very concern which is there. But as I think numbers will come, as things will progress, it will play out. We are very positive on the sector and significantly overweight on the sector that we think it will do very well over next 3, 4, 5 years. And in banking is the one sector which also kind of benefits in the rising interest, minorly rising interest rate cycle, because money you make on your CASA and your own equity is higher as the interest rates go up. When it goes down, you make lower. Your liability side gets repriced with a lag, whereas asset side gets repriced a little faster. So it just kind of have a positive impact on this thing. But the credit growth, I think, is beginning to pick up. Another concern is that if the inflation remains high, credit growth may not happen, which is a genuine concern, and that's where which I alluded to, that probably capex might get pushed for some time and hence might delay the credit growth. Those are the possible scenarios. But beyond that, I don't know why it's not performing. I mean, we remain positive on the sector. In case of investing in non-listed, depends this question, what will be exit options available just in case somebody exits early? So this fund, the way we have designed is it's a 5-year fund, it's a 5-year lock-in fund, and this is by design we have kept it. Of course, we are investing into companies only with the 1 year or 2 year away from the IPO, so we will not invest into early stage kind of companies. And by design we have kept it a locked-in fund because we believe that we want to invest money with a peaceful mind, with a 5-year horizon, and where we think that companies can become 3x of their size. Even along the journey can be a bit volatile, but at least those companies should be able to deliver. And given our faith in the in this theme for next 5 years, we thought the best way to capture investment returns would be through a locked-in fund, and some of the unlisted companies which are right now not accessible by investors in the market can also add to the icing on the cake. That's how we have done, but this is a 5-year locked-in fund. So Anuj is saying, could you go again over the slide with the spaces you are going to focus on the? Just one sec, I will give it a minute. Anuj. So Anuj wants to, you want to see the sectors, right? So, is the presentation still shared or no? So this is the sectors which we in the manufacturing space, specifically chemicals, APIs, and pharma, capital goods, consumer electronics, auto ancillaries, defense, industrial capex ancillaries, and building materials. And like I was saying, many more which are building, and we are seeing. So at each of this sector, if you're seeing, they're part of two things: import substitution and export opportunity, right? Like I was saying, government identified, and all of them are forming part of that PMP, phase manufacturing plan, where government is wanting to reduce imports to zero in next 5 years. So they are going to be big beneficiary of that. And at the same time, they are also beneficiary of China plus one. So we all know that China has almost close to 34-35% market share in the chemicals. Now many of them are already beginning to shift. The people who are there in the chemicals space are beginning to see, and we are seeing highest ever capex done by or being planned and done by the entire industry, right? So that is only sort of alluding and indicating the fact that the demand environment is very robust. So each of these sort of segments when we are seeing, there's a huge demand, and they are fitting between these two: import substitution and export opportunity. So this, and of course, some places where there are even market consolidation happening, like in chemicals, no more you can run a plant which in the old ways. So players who are adhering to the higher standard of environmental clearances and manufacturing processes are only going to benefit. People who were used to doing business in substandard practices won't benefit. So to some extent, those people also are getting out, and we are beginning to see happening that. And so wherever even some amount of market consolidation also is happening. I have answered your question, Anuj. The next question is so Amit is saying, don't you think the world will go down towards deglobalization? So of course, partly it is already happening. If you see most companies, it's like earlier China, India was very comfortable importing things from China, and now it is talking about manufacturing, at our in our own country. So to some extent, that trend is not now. It's been on for last 5-6 years. But the thing is that in current today in completely integrated world, we cannot have a massive deglobalization. So let us see today, if let's say America wants to produce their goods, or Europe wants to produce their goods locally, no matter what, whether let's say it is textile, garments, footwear, and many more, for that matter, can they economically or cost competitively produce? Answer is no. So they will probably go and produce things which can be done with the advancement of the technology, low labor cost. So some part of those businesses will go there, no doubt on that. And another fallout of deglobalization, by the way, is the high inflation. Because in last 20-30 years, the world supplied or China supplied to the world low cost manufactured goods, especially to US, and US dollar was strengthening. So US managed inflation through China and strong dollar. Both are changing, and as both are changing, you will see US inflation, in my opinion, will be quite sticky. It will not probably go away in a hurry. But I think that's the reason US will be forced to sort of look at, and today also, by the way, China's current account surplus with US continues to grow. Forget about reducing, it continues to grow. So today US, even if they want, they don't have ability to kind of manufacture locally, right? So they will probably be forced to look at other sourcing places like of India, Vietnam, and sort of kind of places. But I don't think this trend can sort of go back to where it was, let's say 30-40 years ago. AJ, I had a question about INR with your expectation of the trend towards a surplus. What do you think about INR appreciation? So AJ, I think the INR from a next 1 to 2 years perspective can remain soft for sure, because like I was saying that this current account deficit will remain because we are importing right now a lot of capital goods, entire capex. I mean, India is not self-sufficient in capex capital goods, and that's kind of, especially in the high-end capital goods. So we will keep on import. So our short-term next 1 to 2 years perspective, I think probably we'll see stable to soft currency. But if I were to look at 3 to 5 year perspective, I think we will be seeing more appreciating currency. Because all those things will start kicking in, and impact of that will start playing out. And if for some reason in next 2 years, if hydrogen becomes successful in terms of beginning to see some sort of replacement of our fuel, I think that could be very big game-changing event for India. While somebody the stature of Mukesh Ambani has announced that in next few years they're targeting to have a hydrogen fuel at $1 a kilo, and if that happens, I think that could be very big game changing. But that's just more, I would say, right now pie in the sky, and one can't really bet on that. But I'm saying even if it's normal with these themes, I think rupee will be more on a stable to appreciating. Gone are the days where we will see currency depreciating by 5% every year. I don't think we will see that in a big way. We are seeing drawdowns in IT. Does size of company above 1 billion has advantage over smaller ones? So, again, I always have believed that short-term corrections should never be looked at confused with the long-term trends. I mean, while IT have drawn down in the last 3 months, but before that, all the IT stocks became 5x. So after becoming 5x, if a sector is corrected by, let's say, 30%, I think that's very natural to happen and will happen. But if you listen to the commentary of every company, big, small, large, every company has alluded to only one fact, that the demand environment is very, very strong. So if that is the case, of course, they are also facing a bit of challenges in terms of managing the attrition and the short-term sort of those challenges. But IT companies have handled this over 30 years in many times over. but sometimes it is currency volatility, sometimes it is environment volatility, sometimes it is manpower volatility. So all those things they have done, and these companies have evolved and evolved. Otherwise you can't run such large businesses. So I think sector is well placed. Company above $1 billion has advantage over smaller size, uh, especially to win the large contracts in the large corporation. But you must keep in mind that mid-cap IT companies also have a very big role, because the globally even SMEs are also needing tech solutions. They also need to have digitization and cloud migration, and it is it is uh, these smaller companies which can cater to another smaller company. I mean, TCS probably may not be chasing a $500,000 contract, but the smaller companies will definitely. So that demand is also very robust, and that's the reason if you see smaller companies are also growing at rapid pace. Some of the smaller companies are rather growing at higher pace than the larger companies, because they can sort of a lower base, but secondly also they can be a little bit more nimble in terms of getting accounts. Can the sector get derated more in your opinion? I don't think it can get more derated. I mean, we already seen bit amount of derating. Technically anything can happen, but I personally, the only situation where which will worry me is, let's say if US gets into a stagflation kind of environment and US or recessionary kind of environment, I would assign 10 to 15% probability to that. If that were to happen, then to some extent IT demand can get pushed, and you might see some of what worries playing out. But I frankly don't see too much risk, because even if that happens, it's not that demand is going to go away. No company can afford to not spend money in IT. I was talking to a client of ours who is also works with a very large IT company. Who is our investor. He was telling me that he's working on a project of a company, insurance company in US, whose systems were designed in 80s. So he said we have to do complete transformation of that company. Now, even if tomorrow US were to go into slightly slow down, can that company not to sort of transform and not do, because the journey is already begun. So this is the kind of situation where there every company is kind of going towards cloud and digitization. That journey has to be completed. So you might see some slowdown, but I don't see a reversal. And most IT companies are now right now much cheaper than the consumer companies. Now, if you ask me which consumer company is growing at 15%, I don't know. So very few companies, can have that kind of volume growth, and 100% free cash flow generation. So I see this sector should definitely, get premium, and these companies are annuitized revenue. So they continue to, once you are in the system, you keep on getting a repeated revenue from the customer. So we remain sort of quite positive. We think large part of the correction is done. Uh, Probably, one in a quarter or two, you'll start seeing some sort of resumption, or growth coming back, or stock kind of stabilizing and doing well. Are you going to invest in value stock or growth stocks in AI? Most of the IPOs are priced very high. So very clearly we are going to invest into growth stocks. But when I said that, when we see a company's size can be 2.5 to 3x from the time, because currently the fact that we see high growth in manufacturing, we will invest in high growth. But that does not mean that we will participate only in IPOs and go after the stocks with the 80p and 60p. And one of the reasons why we also wanted to keep unlisted stocks is because we have access to some of the companies which are exceptionally good and coming at a very, very reasonable price compared to, of course, listed companies. But and also structural growth drivers are there in place for them. So we are going after company which is basically high growth and reasonable value. And that is what broadly. And if you look at our portfolio construct of the shift strategy, which is there in the PMS format, there our portfolio ROE is 20%, our portfolio level growth is 27%, portfolio P is at around 22, 23 times. So, that gives you the construct of what we are kind of looking at. I mean, if I have that slide, I can show you. That should give you some good idea about our, yeah, if you see, our, the slide, our portfolio ROE, this is a shift strategy which we launched in October 18. So this is similar, except that it does not have unlisted. So it has 27% growth, portfolio P is 21 times. So this gives you idea that we are not looking for necessarily the crazy valuation, which right now in some of the market offers. Other questions? Pratul bhai, do you think the aggregate number of for NASCOM and manufacturing may be revised looking at the inflation and perhaps demand? So, Pratul bhai, I think, I don't see a major demand revision in IT, because IT again is so you can say if the NASCOM is guided from $165 billion to $350 billion. Now, if let's say the environment were to change, can that get pushed by 1 or 2 years? Answer is yes. It can happen, because nobody can say for sure that this is how it's going to pan out. No matter, even if it is NASCOM, how does it matter? It will, so because it's all data dependent, path dependent, and along the path, a lot of things do change. If they change, of course, every possible outcome is changed. So these are all broad guesstimates. But we hear, even if you see today, TCS CEO has said multiple times on different occasions that they are planning to build a company from $25 billion to $50 billion by 2030. And if the current demand environment remains, they will probably achieve it before. So I think broadly, everybody is seeing a very, very demand. Common sensically speaking, also, which company can today afford not to spend money on digitization, cloud migration? The way of doing business has completely changed. So I think I don't see a destruction. Can it slow down a bit? Answer is yes. But will it go away? I don't think so. And same thing even on the China plus one and the manufacturing side. Today what India is looking to gain is not a market growth, but a market share growth. So if let's say US does not grow, market may not grow, but market share can grow. Our main thing is a market share growth. That is where we are getting the big delta, not the market growth. I would worry a lot on the manufacturing side from stagflation only if we were betting on market growth. We are betting on market share growth. So hence, I would not put a very high probability to that. And towards stagflation, like I said, that I would assign a 15-20% probability that US can see a stagflation, or maybe 25% probability it can see. It depends on again how Fed reacts and what's Fed's policy. There are different views. One view is also in that Fed might play a Volcker and take the pain up front and create the havoc in the economy and bring down the inflation, break the back of inflation, how Volcker did, and take the interest rate higher, much sharp than what it is right now even planning. So there are lots of different viewpoints, and we will only know when it gets implemented and how Fed reacts. But I would say that high inflation is a very big source of worry, and if it remains like this, it can result to stagflation. So I think there's a question about what for unlisted idea, what will the timeline for IPOs? So I said that we will be investing into 1 to 2 years before IPO. We will not invest into very early stage companies, and we will definitely not, and we will not compromise on our risk reward understanding of those companies, framework of those companies, and only when we are comfortable that given the growth, this is justifiable. And we have, like I said, from our historical last 3 years of track record, we have shown that we don't really chase we don't act out of FOMO. We have consistently remained away from these high tech new tech companies because we never believed in many of them, and so we have consistently stayed acting out of FOMO, and that will continue to, unless it makes sense, we won't do it. So and Sanjay is asking that in unlisted companies, how do you derive the price? So again, we have done. I mean, we have a long experience of being in the markets. I have been also an investment banker, so we know. I'm looking at the business, analyzing the business. What kind of value to assign and how to assign. So, and there are broadly parameters available, right? And we see similar companies in the listed space. But our idea is to kind of more importantly get access to the companies which are otherwise not available in the market. Like to give an example, we are talking to a toy manufacturing company. Today, there's no toy manufacturing company in the country, right? On the listed space, we are talking to a very large defense company, very niche defense company which is growing at 40% now, and has a visibility over next 5-7 years, and we are probably going to get at 1/3 the valuation of what is a listed player. So we have said that we will do only at when when we are convinced about the opportunity management and the right price. With HDFC Twin consolidation, Axis picking up City India, Shriram Transport and City Union consolidation, what's your view on NBFC, especially smaller ones? We've always been kind of a bit negative about smaller NBFC for a long time now. I think, according to me, NBFCs, smaller NBFC can do well only if they have some niche capability to lend. But in banking or in lending, most important thing has always, in my mind, been on the liability side. If you have a right liability side, right cost of borrowing, you can sort of always, on a risk-adjusted basis, come out as a reasonably good model. But if you are a smaller NBFC, your borrowing costs are very high, and by force you are supposed to then chase the risky assets to get high returns so that you can make money, and on the top of it you have a leveraged business model. So I think so most of these small NBFCs have never made sense to me, and we have stayed away and we will continue to stay away. The only NBFCs we will look at with probably AAA rating, where the liability side is sort of taken care, where the cost of borrowing is at 5, 6, 7%, so that they don't need to take extra risk to. In a leveraged business model, you want to be going after the safest asset, not the riskiest asset. So that's our thought process. But and we will be happy to be wrong if otherwise works out. So we will stay away. What is our view on the scope of EV? I think again in electron EV segment, according to us right now, while this is a possibly a future technology, but I think it's a very early stage, and there is a literally rush happening to be in it. And I can also use probably there's a FOMO. Most of the people are acting out of FOMO. I mean, as we are told that there are 200 EV companies, especially in the two-wheeler segment, which are in the country right now operating. Now this is not sustainable, and still we are not sure whether EV will, electronic vehicle will, so who are going to be the winners. So we don't know whether it will be incumbents who will be the winner or the newcomers will be the winner. We don't know which technology will win. That talks about hydrogen coming about. So we will wait and watch. The best way of playing this, according to us, is to play through ancillaries. Whether you sell X EV or Y EV, tire will be required. Some of the auto components will be required. Lighting will be required. Steering will be required. Harness will be required. So we feel that they are more better placed players than direct playing EV. So we will not invest into companies which are either in public or private space which are actually selling EVs. That's our thought process. My view on Russia-Ukraine war. I have no view on Russia-Ukraine war. Not a geopolitical expert, but I don't know. I mean, I only know that now it has kind of gone down, and most people are, less sensitive about it than they were 2 months ago. Of course, we are the only broader contour. I know that we are in the middle of a sort of cold war between two powers, China and US, for the supremacy, and all these things are in some sense side effects or side impacts of that. Now US is in a precarious situation, whether they they want to pull out but they cannot pull out, kind of stuff. So I don't know, I'm not a geopolitical expert, but we'll have to wait and watch. I guess it should settle down sometime soon, but you never know. These are the geopolitical situations. Who knows? Do you think manufacturing and technology will create better alpha than financials in 2-3 years time? At valuation, looking at valuation. See, I think probably at a sectoral level, yes. More importantly, at a company level, if you invest into some of the smaller, see, in financials, I believe the large part of the return will be driven by the large cap companies. Okay, but in manufacturing and especially a lot of small and mid cap companies will deliver a very big return because they will multiply from here. In fullness of time, they can become 5x, 6x, and maybe more. Because any sector, when it gets a tailwind, it can go really far. we saw how IT companies in mid-90s to early 2000 did very well, right? When the tailwind was there. So, and many times it has happened, tailwind in any sector, it delivers very well. So I would say that there are two different, I would say that probably manufacturing will definitely do well, but again, if you can't compare because they're apple and oranges. Financials is best played through the large caps. Manufacturing is best played through, in my view, mid and small caps. What are the good books you have read recently? I am right now reading a book on Gita by Vinoba Bhave. It's one of the best book. It's the second time I'm reading. So yeah, that's my recent read. But yeah, there are. I keep reading all the time the different books. So before that I just finished Ray Dalio. Before that, I was reading again. I think one biography. Yeah. So yeah, I keep reading, but I read everything and anything. So good. I think I have probably exhausted most of the questions which are there. Are there anything have I missed? No, I think I've pretty much covered most of the question. If there are more, if there are more questions, please let us know. Otherwise, we can bring the session to an end. Swati. Okay, so thank you very much, everyone, for joining us this afternoon. It was, thanks for your patient listening, and please feel free to reach out to any of us if you have any further questions, or if you want to invest in our fund, or if any of your friends or family invest in our fund. Please feel free to reach out. Thank you.